The US stock market has had a very rough start to 2022, most notably the tech-heavy Nasdaq index, which trades down over 12% so far this year. Well, you may have heard the term stock market correction used. So, what exactly is a stock market correction? A correction is when a market falls 10% from its recent high. And this could be any market, a stock, indices, FX, or a commodity market. The 10% level is, in fact, an arbitrary round number threshold, but a correction is actually a moderate decline in a market. Sometimes the words market correction conjure up a more dramatic picture, with investors thinking of crashes or bear markets. But actually, corrections happen relatively frequently. It suggests that investors have turned more downbeat regarding the market. But are market corrections common? Well, they usually happen when there is an economic shock or a major event in society which prompts investors to pause, step back, reassess, and potentially reset. The Nasdaq has fallen into correction 65 times since its launch in 1971, prior to this current correction. The S&P has fallen into correction 27 times since the Second World War. Generally speaking, corrections can last anywhere from a couple of weeks to a couple of months, but there is no hard and fast rule. If we look at the market correction in February and March 2020, when the virus hit, the correction lasted around 3 months. However, the correction in September 2020 lasted around 20 days. Often, when the economic hit or political development or whatever it was which caused the correction has run its course, then the market will usually rise higher once more. So, how does this differ to a bear market? Well, a bear market is a more sustained sell-off. So, in other words, a longer, deeper version of a correction. A bear market is considered a fall of over 20% and usually lasts for a longer period of time than a correction. Bear markets tend to be the result of a more serious and significant change in sentiment and represent a more critical level of concern in the market than a correction. A market correction could turn into a bear market should the underlying issues build or create sufficient concern. The difference is best noted in the attitude of investors and traders. In a correction, investors remain optimistic about future earnings and the broader economic picture. As a result, they return to the market, buying up bargains and pushing the market higher. On the other hand, in a bear market, the broader outlook is much more negative, which prevents investors from re-entering the market. In the S&P 500, there have been 24 corrections since 1974. Of these, just 5 have developed into bear markets. These started in 1980, 1987, 2000, 2007 and 2020. So, how should you trade in a market downturn? Well, firstly, understand what is causing the market sell-off. For example, the sell-off in the Nasdaq since the start of the year has been on the expectation of a more hawkish Fed. A higher interest rate environment makes high growth stocks environments less attractive. Understanding the reason behind the sell-off can help you make a decision over how to trade it. Secondly, consider hedging your portfolio. In CFD trading, you make money from the movement of the stock or index, and this means that you can make money from a falling market in addition to a rising market. If you have a physical holding in shares, shorting the stock in your CFD could act as an insurance. Should the share price decline, your stock portfolio falls in value, but the CFD rises in value, or vice versa. Thirdly, market corrections are often the first time that new traders and investors really gain an understanding of what their risk tolerance is. It can be useful to have spare funds available to protect your positions or buy the dips if you consider that the market will rise. This way, you are lowering your average entry price. Fourthly, use risk management tools, such as stop losses, so that you don't need to watch the market on a continual basis. Using stepped stop losses can be a useful way to free up some extra cash if needed to support the rest of the position. And this could allow you to ride the position out if you think it will rise again. And finally, stay calm and trade your plan. Corrections are a normal part of market cycles. Don't panic or let emotions lead your trading decisions.